Hi everybody, thank you very much for joining us for this presentation on the benefits of building a tax-efficient investment portfolio. I'd like to give you a few seconds just to read the disclaimer before the session itself gets started. I hope you find it really useful and I hope you enjoy it. Thank you very much. Hi everybody, my name is Abraham Ace. I'm a Chartered Financial Planner at Atticus Financial Planning. And today what I'm going to be talking about is diversification across different tax wrappers and the importance of doing that. I know as financial advisors what we tend to do is we talk a lot about diversification across different asset classes, and that is absolutely fantastic. It reduces volatility, it reduces risk, it gives us an idea of what to expect from a portfolio, but I don't feel like we talk enough about the actual diversification of your investments across different tax wrappers. So that's what I'd like to do today. I'd like to highlight the benefits of diversifying across different tax wrappers, and the way I'd like to do that is by posing a theoretical question, which is how much return can a married couple over 65 generate from their investments before they actually have to start paying tax, or before they become taxpayers. All right, so the standard answer that I get is normally £25,140. And the reason that I get that answer is because most of us know that we have a personal income tax allowance of £12,570 each. So for that married couple, it would be £25,140 between them that they could earn an income, which is normally generated by the pensions that they'd have and their state pension, etc., which would take up that, maybe some dividends thrown in there as well. All right, but there's so much more to this. There's so much more to this equation. So, right, what we also have is we have the capital gains tax allowance. Now that is £12,300 per person each year. All right, and it really is a case of use it or lose it. So for the married couple, it's £24,600 per year, and if they don't use it each year, then it's gone. That's tax savings out the window. So in order to utilize that, what we need is we actually need investments which generate capital gains, which can be offset against this capital gains tax allowance. So that's investment funds, shares, etc. All right. How do we utilize that each year? Well, by having a financial advisor or doing this yourself, you rebalance your portfolio by selling down some of the funds, etc., which have performed quite well, and rebalancing, which then automatically sort of washes out some of those gains against your capital gains tax allowance. All right. We also get a dividend allowance, and that dividend allowance is £2,000 per person each year. That's £4,000 for the married couple. So once again, we need investments which are generating dividends, and that will be investment funds and also shares generating dividends, which can be offset against the dividend allowance each year. Right. We also get an ISA allowance each year. Right. So for each person, it's £20,000 a year. So for the married couple, £40,000 a year. Now, whenever I mention ISAs to clients, quite often they'll turn around and they'll say, oh, come on, an ISA, it's £20,000, a small beer, what good is that for me? Now, this is the benefit of starting early, but also, just to give you a bit of perspective on this, all right, £40,000 a year between that married couple, every single year for 10 years, that's £400,000 in ISAs. All right, if you achieved a bit of growth, let's say 5% per annum, you're heading upwards of £500,000, £600,000 held within ISAs. Now the benefit of ISAs is that any growth that you get within the ISA is tax-free. Any money you take out is tax-free. So that can be really, really useful when you decide to retire. Now, let's say this couple only started saving relatively late on, but they've been doing fairly well. They've managed to build up £200,000 in ISAs. They've got a medium attitude to risk. Okay, so actually they could draw up 4 or 5% per annum probably, and that's reasonably sustainable. They draw up 5% per annum. £200,000, 5% taken out gives us £10,000 each year tax-free. All right. Okay, so that is quite a nice little earner, and it's tax-free. Right, now if we're using all of these allowances and we used our ISAs, then we need to look elsewhere for these tax savings. So let's say the married couple has inherited £200,000. I mean, it's quite normal to inherit money as you go along. So £200,000, and they're wondering what to do with it. So at this point, we'll probably look at investment bonds, either onshore or offshore. All right, so that really depends on your circumstances. But the key thing here is that an investment bond will allow you to draw out up to 5% of the original capital each year, and HMRC regards that as return of capital. So that means that you don't have to declare it on the tax return, and you don't pay tax on that drawing out. It's tax deferred effectively. All right, so that means that if we've got £200,000 in investment bonds that we've invested in there, and we draw out 5% per annum, for the next 20 years we can draw out £10,000. We don't have to draw out 5% each year, we could say 3% each year to make it more sustainable. And then that would be £6,000 a year over 33 years that we could take out of there. There's a lot of flexibility there, but the key thing really is just that you're not paying tax on this. Okay. Now, once again, we can tweak this even further. If we look at, let's say, one of them or both of them were additional rate taxpayers during their life, and what they've done is they've actually saved into venture capital trusts, VCTs. Now, the nice thing about VCT is if you save money into it, you get 30% tax relief off your income tax. So let's say they've saved £100,000 into VCTs. So if they saved £100,000 in, they would have got initially £30,000 tax relief. It's 30% of 100,000, right? But the dividends generated by venture capital trusts are also tax-free. And actually, when they generate dividends, it's quite often quite chunky. So what I've used over here is quite a moderate dividend rate of 5% per annum on 100,000. That's £5,000 per annum, tax-free. So if we look at this couple and we look at how we've actually set everything up for them, and we've utilised all these allowances and all the structures that they've actually utilised, they're actually earning £78,740 before they become taxpayers, before they have to stop paying tax. Now, I need to highlight that this is a theoretical exercise, but it highlights a couple of things. So the main thing it highlights is that it's really, really important to diversify your investments across different tax wrappers, all right? Because it allows you different sources of income, all which are taxed differently, and it allows you to use different tax allowances. Also, if the government decides to change, for example, how the income from pensions is taxed, which makes it less beneficial to draw an income from the pension, you still have all these other sources of income that you can actually draw down from if you want to. So by diversifying across tax wrappers, we protect against the risk of tax changes. Right. So in order to get this kind of situation in place, and you know, in my career I've done better than this and I've done worse than this in terms of what we've been able to achieve for clients. But the key thing is that the earlier you actually start putting together the structure and structuring your portfolio, the better off you're going to be. So if you'd like to discuss this any further, just give us a call at Atticus Financial Planning. We're always happy to have a discussion. Thanks very much for joining us today. I hope you found it useful. If you'd like any further information, all our contact details are below. Feel free to get in touch with us anytime. Thank you.